Hello everyone, it's Professor Reiko. Today in this video we are going to introduce our inventory cost flow methods, and then the next couple of videos we'll go through examples of a few of those. So we got 2 or 3 videos that are all pretty much related here coming up. All right. So when we're talking about inventory cost flow methods, what we're really trying to do is figure out how the main thing we're looking at here is what is going to be the value of cost of goods sold and ending inventory on our balance sheet. All right, so if you think about it, those are 2 rather large numbers for companies. I mean, if you think about like Home Depot or Walmart, they had their inventory balances. If you think about every Walmart across the world, every warehouse, every piece of inventory they own, that's a large dollar value. And every time they make a sale, they record the cost of goods sold on that. So these are 2 big numbers. So, if you look at it up here, it says when a company purchases several units over a period at different times and different prices. All right, so let's just take that first part of that sentence. Let's say we're out. Walmart buys boxes of Fruit Loops. All right, so they're going to buy those and they're going to replenish their stock as needed over and over and over again. Well, the price of those Fruit Loops may change. Okay, so you may buy. Let's say they buy a box for $1.05, and then for $1.07, and then for $1.08, and then maybe it goes back down to $1.06, or whatever the case may be, meaning the price changes. Well, when they get all those boxes there and they're all on the shelves, they can't tell which box is which. They all have the same UPC on them, the barcode. They all have the same, they're the same boxes, this and that. And so when they sell them, what price do they assign to them? The $1.05, the $1.06, 7, 8, 9, 10. So they have to come up with some sort of system by which they're going to put the cost on it. And that's what we're going to talk about here. All right, so and that's what this first paragraph is kind of mentioning here. So there's 4 main ones that we're going to worry about. All right, so the first one is specific identification. Okay, this means you can identify each item sold and each item left in inventory to the actual invoice related to that specific item. So these are specialized items. So the examples here, like jewelry. If you go into a jewelry store, they're all, diamonds may look the same to some people, but they're all different cuts and carats and color and whatever the other C's are. You think about a car dealership. If you go to a new car lot, they have those, the invoice, the stickers on the window. Okay, so that's unique to each car. All right, so they know specifically what's being sold. All right, so as far as this chapter, you typically won't have specific identification show up in a problem, but you will have the next 3. So let's talk about those in a little more detail. All right, so the first one is average cost. All right, so it says a weighted average unit cost. So don't let all this wording confuse you. We'll kind of put some numbers to it in the next few videos. But a weighted average unit cost is calculated. All right, so here's what we need to remember: by dividing the cost of goods available for sale, remember, which is beginning inventory and purchases. All right, and you'll notice at the bottom I've got that formula again. We'll talk about that in a second. Okay, so we're going to divide that by the number of units available. Okay, so basically what we're saying here is we are taking the dollar available divided by the units available. All right, so notice that's cost per unit. So that's going to give us an average cost per unit, and then we're going to multiply that cost per unit by the number of units left over, and that will tell us what the ending inventory is, and then multiply it again by the cost of goods sold, how many were sold, and that will give us our cost of goods sold number. All right, so one thing to keep straight for number 2, 3, and 4 here is the difference between perpetual and periodic inventory. So remember, periodic means we just do the inventory at the end of the period. Perpetual means we're always keeping up with inventory. So if we are using a perpetual system, we're going to have to calculate do this calculation right here after every purchase. We're going to have to update our average unit cost after every purchase so we can apply it to the next sale. So definitely a little bit more work there when we are using the perpetual. And remember, most people use perpetual systems. All right, our next 2 are Fifo and Lifo. So Fifo, you can see here, first in, first out. So that just means the first units purchased are deemed to be the first unit sold. So the first ones in are the first ones out. Okay, so the ending inventory is composed of the most recently purchased items. So think about that. The ending inventory is the most recent purchased items because all the old stuff is considered sold. All right, so if we're using a perpetual system, a cost is attached to every sale. Okay, same thing as what we just mentioned for the average cost. And then under FIFO, the two items are the same regardless. The ending inventory and cost of goods sold are both going to be the same regardless of periodic or perpetual. So we'll see that in just a second when we start going through an example. All right, the last one is LIFO, the last in, first out. So that means the last units purchased are deemed to be the first unit sold. Okay, so the last ones in are the first unit sold. So the inventory is always going to be composed of the oldest units. All right, so this poses a problem that we'll get to in a future video, and we'll go into some of the special issues with LIFO, meaning if the old stuff is always left, and it could be, you know, several months or years even before that's cleared out. So there's issues with that. We'll talk about that in future videos. All right, periodic and perpetual will produce different results under LIFO. So that's something to keep straight as well. All right, so number 2, 3, and 4, these are the main ones that we're going to focus on. So make sure you kind of just walk through. I know there's not really any numbers here. We're just talking through it. The next couple of videos, we'll put some numbers to it. All right. So I always like to remind my students of this. This was from the very first video, I believe, on inventory. Is this formula? So remember, you know, up top here, right here, we were talking about the goods available. Up here, you know, goods and units available. Well, what we're saying is that is this number right here. All right, the goods available for sale, which is how much we start with. All right, so beginning inventory, so that's what we start each period with, plus what we add to it, the purchases. That gives us how many we have available. Of that amount available, we either have it still sitting there or it is sold. It's cost of goods sold. All right, so these two numbers right here are the ones that we're trying to figure out how many units we have left in each, and then we're going to apply these cost flow methods to apply the cost or the dollar value to each of those. So that's what all these problems that we're about to do in the next two videos, or the examples that we're about to do, are going to work on coming up with this $23 and this $36 for these two numbers right here. All right, now obviously we're going to use different numbers, but that's what we're trying to figure out. We're trying to come up with what is cost of goods sold that's going to be on the income statement, and what is ending inventory that's going to be on our balance sheet. All right, so make sure, so this is just kind of an introduction to these cost flow methods, so make sure you kind of go through these, have a pretty good grasp for things, and then what we'll do in the next couple of videos is walk through doing numbers 2, 3, and 4 under both perpetual and periodic systems. So make sure you tune into those, and hopefully that will help you have a really good grasp on inventory cost flow methods. All right, I'll see you guys next time.